This one possibly slipped under the radar a little, but could have a big impact on the housing market in the next few years. Specifically, this could be the driver of higher house prices and could impact the buy-to-let mortgage market. So stick with me until the end of the video and I'll explain everything. Last year, lenders got the green light to relax stress tests for residential mortgages on fixes under 5 years, but hardly anyone is talking about it. Stress tests are those what-if scenarios like, can the borrower still afford the loan if interest rates jump? In practice, the stress test meant running the figures on a mortgage at a higher rate of interest than the actual rate being paid to see if the borrower could still afford payments if interest rates increased. It was all a bit hypothetical, but if they couldn't afford payments at the higher notional rate of interest, they didn't get the loan, even if they could afford the payments at the rate that was actually going to be charged. But now lenders don't have to be quite as cautious, and the stress test rules, more accurately guidance, have been relaxed, at least for some borrowers and at the lender's discretion. Apparently the government gave this little nudge because nothing says growth like helping people borrow more. NatWest, Lloyds and Santander have already changed their rules. At the moment, this only applies to residential mortgages and not buy-to-let, at least not directly, but it's still worth paying attention to. Savills reckon this could boost first-time buyer transactions by 24%. That's a big bump and sounds good on paper. But they also say house prices could rise by 5% to 7.5% over 5 years, and that's on top of baseline forecasts. So any gain for buyers from easier mortgages might be offset by rising prices. This looks like a classic case of supply and demand. More people can buy, but there's still not enough stock. More approvals chasing the same homes pushes prices up, so affordability might not improve, just shift sideways. And let's not forget the usual caveat, none of this happens overnight. The market will shift slowly, if at all. So what does this mean for buy-to-let? Directly, not much. Indirectly, possibly a lot. If you're already holding property, price rises could work in your favour. If you're buying, it could get more expensive. But here's the more interesting bit. Some buy-to-let lenders are quietly cutting their stress test rates too. They don't have to follow the same stress test rules as residential, they're less tightly regulated, so they can reduce stress test rates whenever they feel confident. Why would they do that? Probably because they think interest rates are on the way down, and that the market is stable enough to handle the next 12 to 18 months, despite all the noise about inflation, recession, tax increases and general doom and gloom. And sure enough, the Mortgage Works, one of the big players in buy-to-let lending, recently cut their stress test threshold by 0.5%. Lower stress test rates means easier borrowing for investors, and that means raising finance or refinancing could soon get easier. Combine that with a possible but as yet unproven rising market, and things look more positive. But don't get carried away. If the wider economy tanks, 0.5% off a stress test won't save the day, so keep an eye on what's really happening out there. And make sure your deals still stack, with or without the good news. Even if the bank don't stress test your borrowing, you should. Remember, none of this is advice, so run your own numbers and talk to a good mortgage broker before you do anything. If you don't have a good mortgage broker, or if you'd like a second opinion, I'll be very happy to introduce you to my very good mortgage broker. Just email me at thepropertyteacher@gmail.com. That's thepropertyteacher@gmail.com. And I'll make the introduction.